Welcome to The Explainer. Today, we're diving straight into one of the most polarizing stocks on the market right now, Independent Bank Corp, or INDB. Wall Street is honestly sending some massive, conflicting signals on this one, and, well, we need to figure out exactly why. So, is this high-flying bank a trap, or is it a treasure? Wall Street's been pushing a very specific narrative about this community bank lately, but we really need to ask if it's a hidden trap waiting to spring or a genuine treasure for your portfolio. We're not going to rely on the hype here. We're looking strictly at the data. Just look at this. Over the last 52 weeks, this stock has delivered a massive return of over 31%. That's driven the price all the way up to the $83 to $85 range. For a regional community bank, that kind of upward momentum absolutely turns heads. It gets the market buzzing, and it draws in those momentum traders who just don't want to miss out on the rally. But here's where it gets really interesting. Right beneath that impressive growth, there are 7 critical warning signs that the mainstream media is just completely ignoring. They're all in on the momentum, but we're going to unpack every single one of those fundamental red flags today. All right, section 1, the bank and the setup. Before we start weighing those red and green flags, let's establish exactly what this $4 billion bank is actually up to. So, INDB is the holding company for Rockland Trust, operating mainly out of Mass and Rhode Island. But the big story right now is their recent absorption of Enterprise Bank. This is a massive scale-up for them, and honestly, the entire investment thesis hinges on one critical question. Can they successfully integrate this massive acquisition without destroying shareholder value? Moving on to our 7 hidden red flags, let's take a look at what the fundamental data is warning us about, starting with the bear case. Red flag number 1, Guru Focus gives INDB a GF score of just 65 to 66 out of 100. If you're not familiar, that's a measure of financial strength and growth potential. High-quality, scalable banks, they usually sit comfortably above 80. So this mediocre score is a glaring warning sign about their ability to achieve consistent growth. Building on that, we hit red flag 2. You're paying a premium for that mediocre growth. The stock is currently trading 9 to 11% above its estimated intrinsic value, which sits around $76 to $77. Your margin of safety here is practically non-existent. You are buying in at the absolute top of the valuation range. And that premium brings us to red flag 3, valuation stretch. They're trading at a trailing PE ratio of 15.2 times. When you consider the U.S. banking industry average is hovering around 12.7, it's pretty clear the stock is priced for perfection. And let's be real, the current macroeconomic environment is anything but perfect. This perfectly sets up red flag 4, a massive negative PIG ratio of minus 10.16. Translating that into plain English, their earnings growth is actually shrinking and unstable relative to that high price tag. In a growth at a reasonable price framework, a negative PIG is basically a blaring siren. It means you're paying top dollar for a company whose growth engine is kind of stalling out. Flags 5 and 6 come down to operational efficiency. Their return on equity is an underwhelming 8.24%, and return on assets is a mere 1.21%. Industry leaders easily hit 12 to 15% ROE, right? And because of this inefficiency, sophisticated money is definitely taking notice. An elevated short interest of over 4% implies hedge funds are actively placing bets against them. Finally, red flag 7, the elephant in the room. Management themselves have openly admitted to significant commercial real estate exposure. In our current higher-for-longer rate environment, where office buildings are just sitting empty and valuations are tanking, this is a very genuine structural risk that could weigh heavily on their balance sheet. Okay, so that is a fairly heavy bear case. But let's look at the 7 overlooked green flags and build the bullish case for INDD. Green flags 1, 2, and 3 really highlight Wall Street's optimism here. Analysts maintain strong consensus buy ratings, targeting around $93. That's an 11% upside. Why? Well, INDB holds a top 10 market share for low-cost core deposits everywhere they operate. You take that cheap, reliable capital, combine it with a massive 30% target for cost synergies from the Enterprise Bank deal, and you've got a serious recipe for long-term profitability. Green flag 4 is strictly for the income seekers, a rock-solid 3.05% dividend yield. And what makes this so attractive is the 53% payout ratio. That means the dividend is very comfortably covered by earnings, leaving plenty of cash to fund that massive integration process or even bump up the payout down the line. Green Flag 5 highlights their spectacular recent earnings momentum. Q2 earnings per share surged from $1.25 last year to $1.70 this year. That's a 36% year-over-year jump. It absolutely proves that despite all the macro headwinds in the banking sector, they are still finding ways to crank out serious bottom-line growth. Rounding out the scale with Green Flags 6 and 7, we're seeing massive institutional validation. Nearly 89% of all shares are held by heavyweights like BlackRock and Vanguard. Plus, their Piotrowski F-score, which is a super strict 9-point test of financial health, sits at a solid 6 to 7. This basically proves the balance sheet is surprisingly healthy, acting as a sturdy buffer against those commercial real estate risks we just talked about. Moving to our next section, testing the investment legends. Let's see how the heavyweights score this perfect paradox. So when we run this setup through legendary investment frameworks, something absolutely fascinating happens. Every single one gives it a mixed verdict. Morningstar's moat analysis loves the local deposits, but warns the market is highly competitive. Benjamin Graham, he'd love the low price-to-book ratio, but he'd instantly reject that high PE. Peter Lynch would be terrified of the negative peg, but drawn to the 27% forecast growth. And Warren Buffett, that 8.24% ROE is just a fundamental deal breaker for him, even with consistent earnings. Nobody's rejecting it, but nobody's giving it a clean endorsement either.
All right, final section, the final investor verdict. Since the legends are tied, let's tailor the INDB paradox to your specific portfolio. The fundamental question here is a massive balancing act. Can those expected 30% cost synergies and that 36% EPS growth actually outrun a heavily stretched valuation, a negative peg, and looming commercial real estate risks? It literally all comes down to which side of the scale aligns with your personal investment thesis.
Your verdict depends entirely on your strategy. If you're hunting for income or momentum, INDB is a strong consider. That 3% yield is secure, and it's riding a 31% return wave. But if you're a strict value investor following Graham or Buffett, the data strongly suggests you should hit pause and just wait for a pullback to that $76 to $78 intrinsic value level before putting your capital on the line. To wrap up this explainer, we really have to remember Buffett's golden rule. Price is what you pay, value is what you get. Right now, at $85 a share, you're absolutely paying a premium price for a bank that's only delivering an 8% return on equity. So I leave you with this. Looking at the data we just unpacked, are you going to patiently wait for that $76 pullback to get a proper margin of safety? Or is that well-covered 3% dividend yield and massive integration upside just too good to pass up right now? Let me know where you stand, keep learning, and I'll catch you in the next explainer.